Hello there, everyone, and thank you so much for joining us today. I'm Sam, and I moderate these weekly webinars. And in just a second, we're going to be joined by Patrick Ray. Patrick is going to be covering how tariffs may affect your lump sum pension payout. It's a very popular topic right now. And afterward, I apologize, we will not have time to answer questions, but I encourage you to still ask away. It's completely anonymous, and I'll make sure one of our financial advisors can address those questions with you either through phone or email after the presentation has ended. Throughout Patrick's presentation, I will be entering some links. You're going to see them pop up on your screen. They're going to guide you to various resources we have available. Some are on our website, as well as a link to our YouTube and our LinkedIn, where you can follow us for much more retirement-related content. So I encourage you to do that. And as a final reminder, I would like to just remind you all that we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. And without further ado, let's jump right into the content with Patrick Ray.
Hello and welcome, everyone. My name is Patrick Ray. I am one of the senior advisors here with the retirement group, and we have a lot to cover today. Today we're going to talk about a recent topic that has seemed to concern a number of our clients now that we have a direction of who the next president is going to be, and based on that information, how a question that has come up on a very frequent basis might impact them, and it's related to the tariffs that could potentially be assessed. And we're going to talk about not only the tariffs, but specifically how they are potentially affecting your pension values and specifically your retirement planning decisions. So we're going to discuss that for sure, and then talk a little bit about pension disbursements, because in correlation to how your pensions are affected, it might dictate or change the way we think about how to take our disbursements when we decide to retire from the company that we're working with. And then ultimately, we're going to give you our advice on our best practices of what this all means to you in the grand scheme of things. So let's talk a little bit about how tariffs affect your pension, okay? Think of tariffs as a tax, and the tariff increases the cost of imported goods, which effectively raises consumer prices. So you and I are paying more for our goods and services. And in the same context, because of a competition-related concern, domestic producers have a vested interest to potentially hike their prices because of the reduced competition, given that we might not be importing as many goods and services because of the costs. And so what that means is higher production costs. And in an environment like, as an example, importing steel, it leads to higher pricier consumer goods. And so when we see inflation's on the rise, businesses obviously have to pass those costs on to us as customers or consumers. And so in a cost-effective world, tariffs are not an ideal circumstance. But what we're here to talk specifically about is how, if those were to apply, how that impacts not only your potential pension values, but how that impacts your retirement planning decisions as a whole. So the impact on the lump sum pension values is when you have an interest rate environment that where your pension values are dependent on what the interest rates are doing, or moving, or how they're interacting. The lump sum pension values are calculated based on prevailing interest rates, which means higher rates are driving inflation, which in turn has a lower present value of your lump sum. So these things have an inverse relationship to one another. You have higher interest rate environments, you have a lower lump sum. So if you have a lump sum related to the pension plan that you work for, the company you work for, and you're considering taking the lump sum, you would absolutely want to be checked in and understand how this would impact your lump sum values. And so if we look at the 10-year Treasury and the yield effect on what this means, where tariffs would introduce inflation and bond prices or bond yields rise, this reduces the retiree's lump sum from a distribution perspective, which also deflates your bond values. And so when we think in terms of what an environment is ideal from a pension planning perspective, you want to leave potentially in the lowest interest rate environment possible that you could sign up for, because it would inflate your pension value lump sum to the highest amount it could be. So for financial considerations for retirees, retirement planning adjustments could potentially be required, and certainly it would make a ton of sense to at least understand how this correlates or doesn't correlate to you and your family's planning decisions. So tariffs indirectly affect pension values, which affect our retirement portfolios as well, because if you have a higher interest rate environment, typically that affects your bond and bond values in a negative way. And so if you have any exposure to the fixed income world, you're going to want to know how this applies to you. And oh, by the way, if you're considering taking the lump sum, furthermore, it impacts what you could potentially think about as far as how or what might be the values of your pensions if interest rates are on the rise and we are in an inflationary environment. So from a diversification strategy, this screams a significant importance if it had already not been implemented from a planning perspective, which is balancing these things that are at risk to be affected most by interest rate fluctuation and specifically inflation, where you specifically have a bond heavy portfolio, or if you have assets that are correlated to the fixed interest rate or fixed income markets, that you might want to reduce the exposure to that and consider other asset classes to help you balance the overall risk you're taking in your portfolio. And so you could consider things like having shorter term durations on your bond yields or your bond exposure. And in turn, you could also diversify those and pay attention to the quality and the location of where those bonds are being generated from, whether they're corporations or they're high yield bonds or they're junk bonds and things of this nature. So all of these things would play a role in the considerations of what we would have if we're in an environment because tariffs were assessed and all of a sudden it leads to an inflationary environment which has higher interest rates correlated to it, and now all of a sudden we're concerned about lower pension values from a retirement perspective. So this leads into some of the discussions that maybe you hadn't had before because you just automatically assumed that the right move is to make and take the lump sum for your family, when in fact you might want to consider the opposite because of the impact of what these interest rates might mean to you and your overall family. So most of you have a single life annuity format. So if you're going to take the monthly single annuity from your pension plan, this is going to pay you the most money. This is going to pay you the most money each and every month. And the reality is that when you suffer an untimely death, those payments stop. And so these payments are designed to continue through your lifetime, whether you live for 6 months or you live to be 105 years old. The single life annuity would give you the most on a monthly basis, and it would pay you the most over time, assuming that you lived way beyond life expectancy. Now, the joint and survivor annuity is a very popular option for those of you who to consider take a monthly payout, and you want to ensure that your spouse is going to get a portion or all of what you're getting while you're alive. And so upon your death, a percentage of what your monthly benefit is paid to the joint annuitant over his or her lifetime if she or he outlives you. Now, the question that comes up sometimes is if you decide to do this and you take a reduction of your pension value, and the assumption is that you're insuring your spouse's life, what happens if your spouse suffers an untimely death before you do? And some plans have what's referred to as a pop-up provision, which allows the surviving spouse that insured a reduction of their monthly payouts to pay out their spouse who is now deceased, could actually bump their pension value and their single life annuity format back to the single life annuity format instead of the joint survivor option, which would then increase what you're getting and pay you the most money for the rest of your lifetime. And then, of course, if that happens when you suffer an untimely death, those payments would stop. And so the reduction factors apply off of the single life annuity amount. So dependent on how much of this payment you want to go to your spouse will dictate how much you're giving up in return. And so the more you want your spouse to be paid, the more they're going to deduct from your monthly payouts. And think of it as an insurance protection for your spouse. And so basically, if your single life annuity payment, as an example, is $2,000 a month, and in order to get your spouse the 100% option, you have to elect the option that gives you a $1,500 a month payment. But then when you die, your payment of $1,500 goes to your spouse for their lifetimes. You're giving up $500 a month, right? So in other words, you're buying $500 worth a month per month of insurance protection to ensure that your spouse has an income stream for the rest of their lives. And so something to consider is there are alternative methods in an effort to do that type of planning on your own. So we won't get into that today, but certainly something that you need to be mindful of if you're considering the joint and survivor annuity option. And then, of course, you have the lump sum option for those of you who are fortunate enough to have a pension value who allows you to take a lump sum when you consider or leave the payroll. And so the lump sum payment is an actuarial equivalent of those single life annuity payments over your life expectancy given to you at one time. And they're calculated based on life expectancy and actuarial factors, along with the interest rate environment, which affects when you start your annuity, of course. And so these discussions of how potential tariffs, as an example of what our discussion was earlier, and how that correlates to potentially higher inflation, which is leading to higher interest rates, which has a negative effect to your lump sum, all of things that you certainly want to consider. Now, when you take the lump sum, of course, you're removing the capital from the pension value and moving it hopefully to an IRA in most cases, so that's not a taxable event to you. And then what happens is, of course, if you suffer an untimely death, the beneficiary of your IRA would apply to whomever will get those funds, and there would be no death benefit payable directly from the company because there's no more funds available. And so to further illustrate the correlation of what interest rates do to values, I want to bring your attention to this slide that talks about the difference between mortgages versus annuity payouts. And so if we think of your annuity payout as a mortgage payment, right? And on the left, we have Bank A, that we can afford a $1,950 per month mortgage payment. And Bank A is going to loan us money at 4%. We get a 30-year term, which is a life expectancy of a standard mortgage. And so therefore, the Bank A would allow us to purchase a $408,500 home. Fantastic. But what if we look at Bank B, who is also aware that we can only afford a $1,950 mortgage payment, but they're going to loan us money at 3% instead of 4%. We're going to have the same 30-year term. As you can see, we have a significant increase in the home value that we can purchase because now we can purchase a home worth $462,500. And so this illustrates the difference between a higher and lower interest rate environment and what that does to your lump sum. So as an illustration, for every 1% of interest rate change, you can expect your lump sum to be impacted by roughly 10 to 12 percentage points. So if the interest rates are going up, you can see a 10 to 12% reduction in your lump sum. And further, if the interest rates happen to be going down, then you could expect a 10 to 12% increase in your lump sum. So having said that, in the movement of what we calculate or how these benefits are calculated, there are certain scenarios where they have look-back periods on the time frame of what effectively gives you a crystal ball to make a perfect decision in a current environment with what's best for you and your family on how to interact or how the interest rates are interacting with your pension values. And so in a period where they take a look back, they're exploring the historical interest rate data, and this look-back window gives employees the necessity of the interest rate environment and the information to make good decisions, right? And what it allows us to do is give you an environment to leave where interest rates are as low as they possibly can be, which would push out the most money to you if you're considering taking the lump sum. And so typically higher historical interest rates might lead to a smaller lump sum payment or vice versa, which could dictate you potentially retiring sooner than you otherwise had planned, and or retiring longer or staying at work longer than you otherwise had anticipated. And so these trends during the look back window can give the effective present value monies or an understanding of what those monies are so that you can make the best and most informed decision for you and your family. And so you should absolutely be aware of the implications of this and the potential biases that come with informed decisions of knowing specifically what the interest rates are doing and how that impacts your decision. Another way to look at this is what's happening currently. And so if we look at the IRS segment rates, we can see that in early January, you have three different segments, first of all. So segment 1 deals with the first 5 years of your retirement. Segment 2 deals with years 6 through 20. And then segment 3 deals with years 21 plus. And so you can see from early this year to where we are today, these rates had, in the first quarter of 2024, they went up. And then they went drastically down when the improvements of reductions came from the Federal Reserve and the interest rates were cut. And so what happens is this story tells us that if you have a lump sum option and these rates are being reduced, that you can expect a higher version of what this means to your lump sum if you're considering retiring. And so in the current environment, we went from a close to a 5% rate in January of 2024 down to where first segment is today, which is 4.17. And so that's a 72 basis point drop. And remember I said for roughly every 1% of interest rate change, you can expect that to affect your pension value by roughly 10 to 12 percentage points. So these are worthwhile numbers to know and certainly want to play a role or should play a role in your decision of when and what decision to make with respect to how you take your pension plans and when to actually retire. The catch for us is most people don't have a written financial plan. And so how are you supposed to know which decision to take or which decision to lean towards? And so if you had assumed the whole time you were working that you were just going to take the lump sum, but in fact it may be better from a numbers perspective for you to take the annuity payment, you need to run a financial analysis to figure that out. And we know that 74% of the people over the age of 50 do not have a written financial plan. And there's no excuse for that because firms like ours use this as an introductory to our services to you to give you some feedback on if it might make sense and if there might be a good fit for us to be able to help guide you into one of the most important financial decisions that you'll ever have to make, and that's to transition from an employee to a retiree. So why would you consider the retirement group? Well, we've got a ton of experience on the team. That's number one. And we have offices all across the country, and we have an intimate knowledge of your 401k plans and your pension plans and the way your pensions are constructed and the medical benefits that you could potentially receive and how that plays a role in your decisions. And so we offer a complimentary cash flow analysis to take some time, if you're willing to spend some time with us, and divulge this information to us so that we can further help you understand where you are today versus where your goals might be today, 3, 5, 10 years from now. And so if you haven't already run a financial analysis, I recommend that you do so. And you can feel free to reach out to us. You can do that in a number of ways. You can call us at 800-900-5867. You can shoot us an email at info@theretirementgroup.com. You can also schedule a time with myself or one of my colleagues that would help you answer some questions that you might have, and maybe we can get that data and information over the phone from you. And then if you're not already following us on LinkedIn, I would encourage you to do that because we have specific pages for certain companies that give you really up-to-date and intimate knowledge of what's happening and how that may play a role in your existence at the company and how that affects your retirement planning decisions and what might be best for you to consider. And it also gets updates on the current status of our webinar schedules and things that we're doing to talk about a myriad of topics, 401ks and taxes and Roth conversions and minimum distribution planning and pension values and all this kind of stuff. So I encourage you to do that if you're not already doing that. So with that, I'm going to leave you for today. I appreciate you spending some time with us. I hope you found some value in what we had to talk about. And until next time, we'll talk to you later. Take care.